All right, so here we are, the start of the cutting cycle. We're finally here after a long and treacherous journey, mostly holding cash during the hiking cycle and then a little bit of equities at the peak. We're finally at the cutting cycle. And it's looking very dovish. This FOMC was very dovish. These economic projections very dovish. Definitely pointing towards a soft landing scenario. Basically, the most textbook soft landing you can get. They barely rose the unemployment rate in their projections for 2025. What are your thoughts on this latest FOMC?
Well, I obviously think it's like you just said, it's a pretty a textbook soft landing setup, right? So, um, number one, I want to emphasize that literally 11 of the 12 FOMC members were in favor of a 50 basis point cut, right? That was made clear by Powell. So, literally everyone at the FOMC outside of one person acknowledged that they were behind the curve. Right, because if you're not behind the curve, you're not cutting 50 basis points off the rip.
So
So I think that
We were right all along saying that they're behind the curve. I remember that tweet where we said
I
no
know,
rate
I
cuts
know.
this year is a Fed policy mistake.
The
And
hate was unreal.
the hate
The
was
hate
unreal.
was unreal.
It's crazy, but they were actually behind the curve. They should have cut
Yeah,
back in June. I mean, we were saying they should have cut at the start of the year, like back in March, but maybe we were a little bit too early with that call.
that's
But
possible.
yeah, at the end of the day, they acknowledged that they were behind the curve.
Right, and then I think the key takeaway here from this FOMC meeting was obviously number one being 50 basis points. Now, when we say they're behind the curve, it doesn't necessarily mean that, oh, they're late, recession's here, up, it's over, right? That's not really what that means. What that essentially means is there is still some shock likely left in the economy that has yet to flow through from the higher interest rate environment, meaning rates above 5%. Now Fed is below 5 in the high fours. And I think that we can't really measure that. It's variable, long, really unquantifiable. So like there's going to be some time that has to go by here to make sure that, the Fed has really stopped the puck at the right point and we haven't let things go too far, right? Unemployment ticked as high as 4.3 in the last quarter and now is at 4.2. Their median projections for 24 are 4.4. Notice how in their range forecasts for unemployment, they don't have a single print of 5% at or above 5%, right? So what does that tell you? Well, that tells you that the Fed is essentially using like a very precise knife here to fillet the meat, right? They're saying, like, look, we're able to basically bring rates down without letting unemployment. We don't see unemployment going up above 5%. Now, is that guaranteed? Obviously, nothing's guaranteed. These numbers are just thoughts and basically layouts of what the Fed's thinking. These are not by any means more like reliable because they change. You can literally see how they change from one meeting to the next. Ultimately, though, the idea here is that the federal fund rate projections are built upon these forecasts, right? So as you see these forecasts lift in unemployment and fall in inflation, you see that the Fed funds forecasts fall as well. Ultimately, we're seeing that the median for 25 and 26 are decently lower, or all 50 to 70 basis points in 2025 and then 30 basis points in 2026. So, 20 basis points, sorry. So quite a bit of a fall though in the median forecasted Fed funds rate. What does this mean? Well, it just means this. The Fed is seeing the need for more cuts than previously expected, right? Now, what do you think with that scenario? What do you think is going on here with bonds and equities?
Well, we're kind of in a situation now where the floor lifted a little bit. Um, Equities are seeing that, oh, it's QT time. or I mean QE time, rate cutting cycles coming in. That's good for risk assets. Um, so we're kind of in back in that limbo, at least for the short term, of equities outperforming bonds. There's no recession coming. We're gonna make a slowdown.
Right. The slowdown's going to be the end of it, right? Like the slowdown bottoms out, we reaccelerate from here.
Yeah, and to really
Yeah.
see that, we need to see growth rebound, which at the moment we're not seeing growth rebound. We are kind of seeing it remain somewhat low and in contraction territory. But if we're going by a data dependent viewpoint and not looking ahead, it does seem like a good environment for risk on assets as long as the economy doesn't deteriorate from here. But I don't see that. I see that as pretty unlikely because at the end of the day, the Fed remains restrictive even once they cut rates, even with a floor at 3%. That's still a restrictive area. I mean, like this floor that we're seeing right now is still higher than the floor we saw in 2018.
The cycle top, right? So
Yep,
like
right there. Yeah. So,
right now we're priced for 2.8. So I just want to clarify the cycle low is priced for 2.8. We'll go over what exactly that is, but ultimately, as you just said, yeah, the 2.8 floor is in fact 31 rate hike higher than the peak of
yeah, so we're
2019.
still at the end of the day we're still in restrictive territory even with the future forecasts, not at current rates. Current rates were extremely restrictive, but even at the floor, that's still a restrictive floor. And I think it's kind of very optimistic to assume that unemployment's not going to get affected to the point at their projections where it's only slightly higher than where unemployment is today. It's very optimistic to assume that we're only going to have a median of 4.4 next year when the Fed is remaining this restrictive. It
Right.
just
And
it doesn't
right.
really make sense to me.
Right, and then on top of that, right, we have this. So the Fed basically we're at 4.2 right now. That's not what this number is in the bottom here, but we're actually at 4.2. So we're 20 basis points below the median for 25. So you're right. There's a lot that can go wrong between now and 2025, and there's a lot that could go right, right? But there's like given that we're literally up against the unemployment rates median for 25 and it's not 2025 yet is very interesting, right? A lot can shift in that time frame. And to your point, yeah, like the Fed bottoming at 2.8. Um, Now some will say like, okay, the neutral rate is significantly higher from 2019 to the point where like the Fed being at 2.8 is now neutral, right? Whereas maybe the Fed being at 1.5 in 2019 or 2018 was more neutral. I have to say that I don't believe that to be just the case quite yet. I think we need some real cycle time to move neutral rates. I can't see it making sense for us to just look at a year or two and say the neutral rate's significantly higher when all the other data points we look at, and you can pull them up yourself if it's inflation, if it's unemployment, if it's job openings, if it's real growth. Like a lot of these things are buoying out around 2018 levels. So it makes you wonder, well, if the Fed's starting their cutting cycle now, and these figures were quite elevated before, right? So like I'm sure we spoke about job openings and I'll bring this one up because I think this one was a very interesting one, right? We spoke about job openings multiple times. They're back to like the 2018 levels, right? But they were up significantly and they've decayed, right? So pretty much when these started rolling over, we were like very adamant, and this was very early on, that the Fed was in fact restrictive, which is why we started making our call very early on in the hiking cycle that the Fed reached a restrictive territory around 5%. Everyone around us was saying, wow, look, the Fed's going to go to 10. They have to go to 10, right? Everyone was saying 10% interest rates are coming, right? Nonsense, obviously. Um, and we started seeing signs of just moderate weakness in things like job openings, right? They started rolling over. And job openings are a good sign because what they do is they tell you what excess labor is looking like in the market, right? Because you're not going to fire someone if you have an active job opening, right? You're going to close the job opening likely before you have to fire your workforce. So this is kind of like the leading ish indicator of what's happening with labor. And we see this fading quite a bit since 2022, signaling that the Fed has in fact been restrictive, right? So the Fed has in fact been restrictive this entire time. Job openings are back to 2018 levels. To say that the Fed needs to bottom out at 2.8% in 2026, and that is a neutral floor. It's like you said at the beginning of the podcast, Artie, that's very optimistic, because if job openings have come down from 12 to 7 or 12 to 8 million in the last year and a half, where are they going to be the next year and a half? Maybe they reverse, but like odds are, if the Fed is still in fact restrictive, there's likely going to be some headwind pressures here that really can't be avoided without the Fed getting, behind the ball there and bringing rates down to more easy levels.
Yeah. And also, if you go back to their projections, another optimistic point that they put in there is the PCE inflation rate projected at 2.1 for 2025. So that's assuming that they're not going to overshoot inflation. That's pretty much saying inflation is going to come down to their 2% target and remain there. They're not going to overshoot it. We're not going to go into deflation or a substantial disinflation where it's less than 2%. They're assuming that that's going to happen, that they're really just going to nail that. And even that is a very optimistic point.
Right. So like if we take a look at the chart here, this is pretty much the range of what is the cushion in the Fed forecast. So the Fed is basically saying by 2026, so the median I should say through 2026, which is way out here, right? We're talking 2026. 2025? It was 25, right? Median, no, 25. So let's go 25, quick and simple here. So the median through 25 is, right? Now, obviously, it's not this long because there's monthly prints, but say that this blue box here is the time period that the Fed has. We'll make it a little shorter. So the Fed is basically saying that in this time frame, the PCE rate is going to basically median out at 2.1%. And that's the lower line here. So we have from pretty much down here to the lower line to go. We look at what that means in range terms, right? So for PCE, that's 2.1 to 2.4, or essential tendency of 2.1 to 2.2. Okay, so pretty much the Fed is expecting PCE rates to go down minimally from here through 2025. Just like you said, there is no consideration here for any acceleration in disinflation, right? The idea here is pretty much the Fed is going to see the rate of inflation slow significantly, and we are not going to see any type of weakness, nothing like 2018, right? And I think that's the key factor here, because we're seeing, and we'll talk about this right now, the Fed floor actually bottom out at figures that are quite interesting, but we're seeing an environment where the Fed is almost, again, implying the soft landing is completed. This is if this is executed and this happens, this is a perfect textbook soft landing. Now, let's talk about like the floor of policy, what that means. And if you want to just explain to the listeners what the Fed floor means, because some people probably are confused with that topic.
Well, so the floor and the peak, the maximum and minimum lines are what the Fed funds futures are pricing in. So this is basically the end of the rate cutting cycle is going to be at 2.8. That's what the market is pricing in here.
Right. Okay. That's a simple and great way to explain that. Now, obviously we can see that the 2.8, right, is above this flash print of 2.5 in early 2023, this was the SVB crisis. And if you don't remember, not the crisis itself, but going up into it, what happened was very interesting. Going up into the SVB crisis, we saw this phenomenon where rate expectations were actually rising in terms of the Fed having to lift policy higher than expectations. You see how at the time we were pretty much at 4 and 4.5. And out of nowhere, the peak of the hiking cycle goes from 5 to 5.5 in a matter of maybe 45 days. And the floor of the subsequent cutting cycle that would take place lifts from 3 to about 4%. So the entire quarter would get shifted higher on inflation fears, etc., right? Whatever that may be. Long story short, SVB hits the fan. The floor in policy, meaning the rate cutting cycle lows or the anticipated cutting cycle lows, goes from 4 down to 2.5%. Now, I want to note that these are the anticipations over the next 36 months, so it's the next 3 years. So over the next 3 years, as soon as SVB hit, they were forecasting the Fed to get down to 2.5. So if we take a look at where we are today, the forecasted low of the next cutting cycle, which is over the next 3 years, is actually higher than where it was as soon as SVB hit the fan. Now, what does that tell you? Well, that tells you that the Fed really does believe that the floor of interest needs to be higher because the rate that it becomes stimulative has shifted higher. And we spoke about that a few minutes ago in the Fed funds rate, right? Like this idea that the Fed can bottom rates out at 2.8% in a soft landing and not really stimulate, but also relieve restriction in the economy, right? Now, ultimately, I think that's a bit of let's say that's a bit aggressive, right? Because in terms of interest rates, like I'm sure you could attest to this. Like how much of the economy do you think is locked in rates over, let's call it the 3% mark? So call it after 2022. I mean, you live in Canada, right? So how many Canadian mortgages were well, I guess you guys have floating rates, so it's a little bit different up there.
Yeah,
So
most people get variable rates in Canada, and usually 5-year variable.
So I guess if everyone termed out their rates in Canada in pre-COVID, right? And I know these aren't Canadian interest rates, but this is just a hypothetical. If everyone terms out, and this did happen in America with American mortgages, but ultimately, for Canada's sake, if you guys have a 5-year floating rate, right? Like we're talking 2020, and that's 2025. So your refi wall is like approaching, but you haven't really eclipsed it yet.
Yeah, I mean, it depends when you bought, obviously, but yeah,
Obviously, but
there
like
was a lot of
yeah.
purchases happening during COVID. So like 2019 to 2022, a lot of purchases happening then. That's when we saw housing prices skyrocket.
Right. So I would say that in this scenario, right? So hypothetically, you would need to see rates, not at 2.8 to be stimulative. I mean, they would be better than 5, right? But you're not really encroaching on this post GFC refi territory, right? Like this, like if we were to draw a box here, and I think this will kind of make more sense when I do this and essentially explain the point here of what's going on. So if we look at where the Fed is expected to bottom rates out at 2.8%, what you'll notice is like if we go down to the highs that the Fed brought rates to post GFC and then obviously the COVID cutting cycle lows, a lot of financial activity. We're talking about a decade of time in this rate environment, right? Ultimately, could we see a point where there's a higher floor of neutral interest, meaning that 2.8 is actually stimulative to the economy? Yeah, it's possible. I think it's too early to make that call. I think the base call that we have to make right now is that why are rates not going back to 2018, like in the late 2018 levels at a minimum? Like, why is the floor above the 2018-19 peak? Right? Because remember, the Fed, number one, has the inflation target. The inflation target's 2%. So if that target's going to hold true, then at some point, inflation is going to, just as it is now trending above 2%, it's going to trend below 2%, right? And if it trends below 2% for some time, then the Fed's going to obviously have to drop rates well below 2.8%. And I think that's where the situation that we're running into right now is. Like, we're in a situation where the soft landing is implying that inflation doesn't actually gyrate both ways. It just bottoms out here and kind of just stays still. And I think that's pretty much what risk assets need right now. I mean, like you can obviously make the inference that risk assets love a 50 basis point rate cut, right? Like it's
Yeah, well,
pretty
let's
obvious.
let's talk about what the outcomes are for both stocks and bonds and where the alpha is. Like where should money be allocated in this scenario? So the way I see it is right now we've got a soft landing scenario really being cemented into the market, especially after FOMC. It was already somewhat getting cemented, but FOMC really cemented it even more. We saw the Fed funds floor pick up a little bit. And so that soft landing is coming to fruition. But growth, I think, is still really the determining factor on where stocks and bonds go. I think growth right now, where it is right now, we're going to see equities struggle and chop around, and bonds do the same unless we see the floor drop a bit lower.
Right. Now, I do want to clarify with what you're saying, right? Because a lot of people are going to say, well, GDP now says growth is at 2.9%. And yeah, they're right. That's GDP now. That's the forecast for now. Our models look ahead, right? So our growth is the growth that we measure is a growth strength score. It's not necessarily meaning positive or negative, meaning a positive growth strength does not necessarily mean a positive GDP number, and a negative growth strength does not necessarily mean a negative GDP number. All it is an inference of the directional pressures within growth itself, right? Where is growth moving? Not so much what is growth saying right now. So I think that's a key defining factor, because most people are going to look at this and say, growth positive, what are you talking about? They don't understand. So our system isn't designed for face value growth. It's more internal growth, directional pressures rather than the face value of what the growth figure is, meaning if growth is 2.9 or 3, it's not necessarily that important. It's what's moving within growth.
Yeah.
And
And at the
that's
moment,
what we're seeing
growth,
negative.
yeah,
Yeah.
growth is
Yeah.
still negative. And I think the bullish case for bonds, for the long bond trade, is expecting unemployment to rise and growth to fall further. And if you're long equities, what you want to see is unemployment reverse, start going back down with the Fed continuing to cut, and growth rebounding from here. That's where the alpha is in equities if that were to happen. But if you don't believe that, if you believe the other scenario, then bonds are where the alpha is. And the way I see it is the Fed is still restrictive. Unemployment's been slowly and gradually rising. And the way that unemployment works is it rises slowly and then quickly and suddenly, as you could see
Right.
in all the other recessions. And I think the Fed even touched on that during FOMC. There was a question on that.
They did.
And
Yeah.
I don't know if they kind of softened the blow of that question. They kind of brushed it off in a way. But that's really how unemployment works. And you can be as data dependent as you want, which is what the Fed is doing. But at the end of the day, when unemployment just shoots up, when they get that data, they're going to panic. And there's really
Right.
no foreseeing that. I guess you could look at job openings, which job openings have just been coming down, as you said, at a pretty quick rate. That's going to
Yeah.
lead
And
to unemployment rising once that kind of goes through a certain threshold.
let's talk a little bit about like what you just said there, right? So number one, unemployment going up suddenly and then all at once, and job openings being weak. Like, yeah, job openings are in fact weaker. We're back to 2018 levels. So that's obviously again signaling, like we said earlier, there's a lot of indicators that are back into that 2018 level range. And the Fed is at little under 5% now, with the 50 basis point rate cut already happening, and the floor at 2.8%. There's a lot of things that you have to say, okay, why would the floor be higher? And is the Fed in a safe space, right? The Fed would be in a safe space at 2.8% if in fact the neutral rate has significantly shifted up. And that's what we saw in the Fed plots, right? Like we're slowly seeing this neutral rate grind up. We're back to where we were. These were pretty much 2018 figures at 2.9%. So the Fed's obviously intending to get there with gradual cuts. They don't want to reignite inflation, but they also don't want to let labor go loose. And they basically said the risks are more balanced now, meaning labor has more of an importance than it did over the last 2 years, and inflation holds a little bit less of importance, but it's more balanced, not so much lopsided towards inflation. But let's take a look at unemployment. Like you just said, up slowly and then all at once. I think if you're going to make the argument that the neutral rate is in fact much higher than 2018, I think like it's pretty early to make that argument to say that the neutral rate has shifted up where the Fed has to hold rates at a much higher rate than they did in 2018. Like we said earlier, the low of the next cutting cycle is actually a rate hike above the peak of the 2018 hiking cycle. I think to make that observation or that inference, we need to see unemployment pretty much top here. Like if you see unemployment continue to trend up, it would tell me that the Fed is restrictive on pretty much a policy basis across the curve where there is no relief in their easing efforts, meaning their idea of restrictiveness is in fact off. And I think that's something we're only their idea of neutrality in terms of neutral policy rates is off. And I think that's something we're only going to see with time. But back to what you were saying about bonds, man. Look, I think that the bond market saw a little bit of pain here after FOMC. We're talking about, one, maybe 2 down days. And that goes back to the floor actually lifting slightly due to the fact that the neutral rate in the Fed dots are, again, shifting up slightly. So the bond market took that as a little bit of a hint that, okay, maybe there's not going to be as much cutting, pull some odds off the curve for cuts. And therefore, bonds felt a little bit of a smacking, or they got smacked a little bit. But I think the fact that bonds are still up here is a good sign. I think that if we were going into this FOMC meeting and bonds really didn't have this traction, we're up so much from just in this bullish trend. Like if this bullish trend was a lot flatter, I would say, okay, bonds really aren't seeing something. But what you'll notice with bonds, and I've noticed this as well, is if we go through these economic prints, all these bullish economic prints that everyone loves to harp on, and there are some quite, in fact, positive signs in the market, like jobless claims today coming in below estimates, right? Continuing claims coming in below estimates and falling. Like these are not bearish things. But what you'll notice is the bond market doesn't really get weighed down by these bullish or neutral-esque prints. But whenever there's a bearish print, it legs up, like bearish NFP, whatever it may be, right? You'll notice that you could say that the culmination of all the data since July 2nd, when we went into the bond trade, is probably balanced to slightly bearish, but bonds are up quite a bit. And that tells me that maybe the market's just getting ahead of, trying to price in the fact that this policy floor is a little rich. And obviously the bonds are actively pricing in what this policy floor is. Like they're matching, right? Like the bonds are up, so policy floor, they're one and the same. If for us to get higher bond prices, we have to see this floor come down. But I think ultimately the reason this floor has been falling ever since July 2nd, right? We started July 2nd with a floor of 3.5. We're now at 2.8. I think the reason why the floors fell so much with the economic data not seriously deteriorating outside of unemployment is because the headline numbers are obviously delayed, right? And you know this, like we all know this, that by the time we see the headline employment figures and the headline GDP and the headline anything, like damage has been done behind the surface. And I think like there is some economic softening that's occurred here. And I think it's apparent, right? Like our system's obviously negative growth, right? We're seeing the Fed having to up unemployment forecasts since June. Unemployment has risen since June. Job openings continue to fall. Housing, existing home sales just aren't really going anywhere. And we're just seeing inflation back into 2018 ranges. Again, a lot of these economic data points printing 2018-esque ranges. Therefore, I think the economy is a bit softer than the Fed thought and the market thought in June. And it's very possible that if the Fed does stay this restrictive with the floor at 2.8, I think it's a little rich. And I think to say that the Fed is going to bottom the cutting cycle above the 2018 hiking cycle with a lot of these indicators in that 2018 range, I think that is a very hard assumption to make. Just a year and a half. What are we talking? A year? a little over a year since the Fed has peaked rates. It's very hard to make that assumption. I think we need some time to pass for that. But I think we can wrap the podcast up here, guys. Thank you so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.